Welcome to Talk Tickers. We cut through the noise of earnings calls to give you the crucial info.
Exactly. No jargon, just the key takeaways.
And today we're diving into the recent Dynex Capital earnings call. Let's get straight into the results.
Okay, so first up, their net interest income. It's trending upwards.
Good sign. What's driving that?
It looks like it's mainly these new investments they've made, higher yields.
Yeah.
Plus their financing costs are actually coming down a bit.
Okay. Interesting combination.
Yeah, and what's really notable is despite all the interest rate chaos during the quarter.
Which was significant, right?
Oh, absolutely. But the market value swings on their mortgage-backed securities, their RMBS investments versus their hedges. Well, they pretty much canceled each other out. It was close to neutral.
So they navigated that volatility pretty effectively. It also sounds like they've been busy strengthening their finances.
Definitely. They raised a good chunk of capital, $270 million so far this year. And importantly, they managed to do it at a premium to the company's book value. That suggests, investors are feeling pretty confident.
Right. Always a good signal when you can raise money above book.
But there's a flip side. Their leverage ratio, how much they're borrowing relative to their own capital.
Yeah.
That did tick up. It's at 7.8 times now.
Okay, why the increase there? Did they borrow more?
They actually said it wasn't about taking on more debt. The increase was entirely because their book value went down.
Ah, okay. So the denominator shrank. Got it.
What's the book value estimate now?
As of Thursday's close, they pegged it somewhere between $11.55 and $11.65 per share.
And they bumped the dividend earlier this year too, didn't they?
They did, yeah. Back in February, they raised the monthly dividend. So another positive signal for shareholders there.
Okay, so putting it together, better income, successful capital raise, but higher leverage due to book value decline, and a dividend boost. Let's dig into their strategy now. How are they seeing the current market? Well, Dynex management, they actually sound pretty constructive on the current environment.
Really? Despite the volatility?
Yeah, they pointed to things like the steeper yield curve,
right.
The gap between short and long rates,
right.
higher risk premiums, and crucially, lower financing costs. They see these as favorable for their business model.
So they feel they're positioned well.
That's the message. Raising that capital, keeping plenty of liquidity, building portfolio flexibility.
Yeah.
They presented all that as being ready for, a dynamic macro environment, as they put it, which seems likely.
Adaptability seems key. What's the core of their investment thinking right now?
It really boils down to the spread. The difference between the yield they get on agency residential mortgage-backed securities, RMBS, and what it costs them to finance their hedges against rate risk.
And those are both dollar things, right? Relatively linked.
Exactly. Both the dollar denominated, fairly correlated. So their main decisions are around, how much to hedge, how much cash or liquid stuff to keep on hand, and what level of leverage feels right.
And they mentioned liquidity specifically.
They did. Made a point of saying they've intentionally kept a higher liquidity position since way back in 2019. It's like a core part of their risk management playbook now, keeping extra cash ready.
Seems smart, especially given some of the curveballs lately, like that April 2nd tariff announcement. How did that affect things?
Oh, yeah. That definitely sent a shockwave through the markets, didn't it?
For sure.
You saw the classic signs, investors pulling back risk, credit spreads widening out, long-term treasury yields jumping up, and the dollar weakening.
And for Dynex specifically?
The most direct hit for them was in the treasury and swap markets. That's what impacted their book value. They mentioned making some minor tweaks around margin calls and collateral.
Fundamentally, operations okay.
Yeah, they stressed that repo funding, their ability to borrow short-term, stayed really strong. Financing was easily available on good terms. So a market tremor, yes, but not an operational crisis for them.
Okay. And their main playground is agency RMBS. Still bullish there?
Very much so. They still see agency MBS as an excellent place to put capital to work.
Even with all the talk about potential GSE reform, Fannie and Freddie.
They're definitely watching that closely. They said they're preparing for potential policy action, thinking through different market reaction scenarios. But they also hammered home how vital that current GSE guarantee structure is for the whole U.S. financial system.
Yeah, that's a big uncertainty hanging out there. What about the bigger picture, the U.S. dollar, U.S. bonds in general? Lots of debate there.
Dynex acknowledged that, yeah.
Mm-hmm.
They expect maybe some caution towards U.S. assets because of shifting policies. But they don't see a massive, sudden rush out of the dollar or dollar assets. It's just too dominant globally. that kind of shift takes a long, long time.
And they actually see an opportunity there.
Kind of, yeah. They suggested that if others start selling off bonds, including MBS, maybe driven by that caution, well, that could actually create chances for dinks to buy assets cheaper.
Interesting. Turning potential fear into opportunity. So it sounds like they're bracing for change on multiple fronts, not just tariffs.
Absolutely. They specifically mentioned preparing for accelerating changes across tariffs, yes, but also monetary policy, Fed decisions, and regulations.
And their plan.
Agility, scenario planning, and protecting capital. That seems to be the mantra. Be ready for anything, basically.
And the dividend increase we mentioned, how does that fit into their longer-term view?
They frame the dividend as a very deliberate long-term decision. It's not just about this quarter's earnings.
Right. It's based on
a whole mix of things. Their outlook for long-term returns, how much capital they have and expect to have, prevailing yields, liquidity risks, overall risk tolerance, and importantly, taxable income.
So the recent increase signals confidence then.
That's the implication, yes. Confidence in generating solid returns down the road.
Okay, let's shift to some specific from TJ Connolly, their CIO. He gave some portfolio details, right?
He did. He highlighted they delivered a 2.6% total economic return for the quarter.
Which, given the volatility, sounds pretty solid.
It is, especially as he noted mortgage spreads actually widened out. So despite that headwind, the portfolio generated a positive total return. Shows the hedging paid off.
Did they put all that new capital to work straight away?
Not all of it. He said about 2/3 was deployed. They kept the rest back, kind of as dry powder, for flexibility given the market choppiness after the tariffs.
Smart. Any portfolio shifts?
Yeah, a couple of key ones. There shifted exposure down in coupon, meaning towards mortgages with lower interest rates. That helps stabilize the portfolio's duration, makes it less sensitive to big rate swings.
Okay.
And they added some call swaptions, which are basically options used for hedging interest rate risk. Overall, their interest rate stance is kind of neutral, but maybe leaning slightly towards expecting a steeper yield curve.
He called the tariff thing a V event, not a mortgage event. What did he mean by that?
Right. He was drawing a distinction. The initial reaction was classic risk-off money flowing to safety, rates down. That's the first part of the V. But then, very quickly, concerns shifted to the dollar. Potential treasury selling, and rates spiked back up. That's the other side of the V. His point was, it wasn't fundamentally about mortgages themselves, even though MBS spreads did widen significantly in April. But the trading itself stayed orderly, apparently.
And he also confirmed the leverage point.
Yes, reiterated that the leverage increase was purely a function of the lower book value, not taking on more actual debt.
Makes sense. So what are the main risks they're actively managing now?
Volatility is a big one. Connolly expects options will be a core hedging tool going forward. Prepayment risk is another, homeowners refinancing.
Especially with that rocket mortgage Mr. Cooper deal.
Exactly. That's why they're favoring specific types of mortgage pools, specified pools with better prepayment protection, often lower coupons too. And then, of course, the GSE transition risk we talked about, and just general regulatory changes, always keeping an eye on those.
Okay, so lots to manage. But despite all that, they still sound pretty positive on agency RMBS.
Yeah, surprisingly so, perhaps. They actually said the recent volatility and spread widening strengthens their conviction.
How so?
Because those wider spreads, the gap between MBS yields and treasuries or swaps are near historic highs. They think that offers the potential for double-digit returns on equity right now.
Double-digit ROE potential. That's attractive.
Definitely. They also feel the supply-demand balance in the market is pretty healthy. And they're looking at related areas too, like agencies, CMBS, commercial mortgage-backed securities for bonds with credit protection and maybe more predictable duration.
And financing, still stable.
Yep, financing markets holding up well. They expect repo rates, what they pay to borrow, to stay in a pretty tight range.
Byron Boston, the chairman and co-CEO, also weighed in. What was his main message?
He really echoed the confidence in the agency RMBS opportunity, but, tempered it by stressing they need to manage through this rapidly changing world.
Right, opportunity, but with caution.
Exactly. He highlighted their dry powder, the extra capital and the liquidity ready to protect the downside, but also pounce on opportunities. He also talked up the team's experience and the transparency of their balance sheet, everything marked to market.
And mentioned the management alignment.
Yes. Made a point that the exec team has significant skin in the game, big personal investments in the company, aligning their interests with shareholders.
Okay. The Q&A usually throws up some good nuggets too. Anything stand out there?
A few things. They confirmed repo funding costs have been, quote, remarkably stable.
Good to hear.
They doubled down on swaps being their preferred hedge for mortgages, comfortable with the current mix. They reiterated the ROE opportunity from the steep curve and wide spreads, but emphasized balancing that with diversification across different mortgage coupons and into agency CMBS to handle rate volatility.
And the leverage point again?
Again, yes.
Yeah.
Confirmed leverage increase was only due to book value decline. And they added that the bar for adding new risk right now is pretty high. They're being cautious.
What about using their ATM, the at-the-market offering, to raise more capital?
They said it's purely opportunistic. They'll only issue shares if the potential risk-adjusted returns look clearly better than their cost of capital. It has to make sense financially.
And prepping for GSE changes, is it just liquidity?
Liquidity is the main preparation, yes.
Yep.
Being ready for market shocks or policy shifts. But they're also doing deep scenario planning. Regarding assets, they really like lower coupon mortgages right now for their duration, certainty, and what they call compelling convexity.
Okay. And the capital deployment, still about 2/3 deployed.
Yep. Roughly 2/3 of the capital raised last quarter is working. The rest is that liquidity buffer.
How much liquidity do they typically aim for?
They benchmark it against assets, but think of it as maybe 6-7% of equity over the longer term. But they'll hold more, like now, when markets feel more volatile.
Okay, that really paints a full picture. So now for our favorite part, this is not financial advice, outrageous but plausible trade idea. What have you cooked up based on this call?
All right, buckle up. So Dynex is bullish on agency MBS spreads, offering potentially juicy returns, right?
Right, double-digit ROE potential, they said.
But there's this cloud of GSE uncertainty hanging over the whole mortgage market.
Definitely.
So here's the thought. How about going long Dynex capital itself? Betting on their expertise to navigate the MBS market and capture those spreads.
Okay, makes sense based on their commentary. But what's the hedge? Or the outrageous part?
The pairing. Pair the long Dynex position with short positions in, say, regional bank ETFs.
Ah, interesting. Why regional banks?
Well, the thinking is Dynex is a specialist. They live and breathe agency MBS risk management. Regional banks, on the other hand, often hold large amounts of these assets too, but might be less nimble or have broader balance sheet exposures if GSE reform causes major ripples or if rates stay volatile.
So you're betting Dynex can outperform the broader financials exposed to similar assets.
Exactly. You're isolating Dynex' perceived edge in managing MBS risk and capturing spreads, while hedging against a scenario where GSE uncertainty or rate moves hit financials, particularly regional banks holding lots of mortgage assets, harder. It leverages Dynex' specific story against broader sector risk.
That is an interesting angle, pitting the specialists against the generalists in a potentially tricky market. Definitely food for thought and definitely not financial advice.
Precisely. So that wraps up our deep dive into the Dynex Capital earnings call. We've hit the results, the strategy, the risks, the outlook.
Yeah, a really comprehensive look. We hope this breakdown has given you some valuable insights into where Dynex stands and how they're navigating things.
And remember, this is purely for informational purposes. Always do your own research before making any investment decisions.
Absolutely. What are your thoughts out there? How do you see the agency MBS market playing out? What about GSE reform? Jump online, join the conversation.
We'd love to hear your perspective.
Thanks for tuning in to Talk Tickers. We'll catch you next time for another crucial earnings call breakdown.